Hi everyone, I'm here to explain a tax concept that often comes up when dealing with incentive stock options or ISOs called the alternative minimum tax. Don't worry, I'll break it down step by step and we can go over an example together. So incentive stock options are a great benefit that allows you to buy a company stock at a fixed price. However, exercising these options can trigger the alternative minimum tax or AMT, which we'll dive into. You can think of it as pay AMT tax now and slowly get it back later. Why? Because while AMT might make you pay extra tax upfront, you can get this back slowly over time through AMT credit. So think of AMT as a second tax system running in the background. Normally, you pay your taxes based on regular tax rules, but if you exercise ISOs, AMT can kick in and add some extra income to your tax return. This extra income is based on the difference between what you paid for the shares and their current market value, even if you haven't sold them yet. The tricky part is that AMT doesn't allow all deductions, so you end up paying whichever tax is higher, either your regular tax or AMT. Let me give you an example. Let's say you have 1,000 ISO shares. The strike price or what you paid for each share is $1 each. When you exercise your options, the market value is $5 per share. The difference between what you paid for, which is $1, and the market value, which is $5, is $4 per share. Multiply that by 1,000 shares, and you get $4,000 of AMT income. Even though you haven't sold the shares yet, AMT treats that $4,000 as income and taxes you on it. So in the year you exercise those options, you might pay AMT on the $4,000 of paper income. If the AMT is higher than your regular tax, you end up paying the AMT amount. This is why AMT can sometimes feel like an unexpected or surprise tax. The good news is if you pay AMT because of ISOs, you can recover this extra tax over time through what's called the AMT credit. You might not get it back all right away and it can take a few years, but the credit sticks with you until you can use it. It carries over to a future years indefinitely, so you won't lose it. Let's use an example to explain how this works. Say you hold on to those ISO shares for a few years and later you sell them for $8 per share. By this point, your AMT basis has adjusted to $5 per share since you already paid AMT on the initial $4 gain. So now when you sell, you only get tax on the additional $3 per share, $8 minus $5, which is the new AMT basis. This adjustment helps lower your AMT taxable income in the year of sale. The year you sell your shares can be especially helpful for recovering your AMT credit. The AMT basis adjustment we just talked about helps reduce your AMT taxable income, which allows you to use more of your AMT credit that year. So one thing to keep in mind, if you're still subject to AMT in future years, you won't be able to use the credit right away, but it carries forward indefinitely. Eventually, when AMT no longer applies, you'll be able to take full advantage of the credit and get your overpaid tax back. To wrap it all up, exercising ISOs can trigger AMT, which means you might pay more tax upfront, but the AMT credit is there to ensure you recover that overpaid tax over time. It might take some patience, but in the long run, it's a tax saving strategy. So that's the overview. Thank you for listening and hope you learned something.